Thank you everybody for joining us today for our It's Not Natural to Live in a Co-op or Condominium McCool School class. This is one of our classes that are designed to educate property managers and board members. This one is about who is responsible for what in community associations. One attendee will be randomly selected. Oh, there's the chimes, 2 o'clock. Randomly chosen to win a $50 Amazon gift card. We'll contact the winner tomorrow by email. And the Q&A is open today if you have any questions you'd like to ask along the way. Presenting today, we have Ed McCool and Stephen McCool. As the CEO of McCool Risk Solutions, Ed is responsible for running all facets of the business. As a certified insurance counselor and chartered property casualty underwriter, he brings nearly 30 years of experience in insurance and risk management to McCool. Specializing in personal, commercial, business, real estate, and employee benefits, McCool Risk Solutions is recognized as one of the finest personal insurance agencies in the New York metropolitan area. And as a business development specialist, Stephen is responsible for bringing in business and educating his clients on community association insurance. He teaches classes on various topics of interest to property managers, board members, and unit owners, and he's working toward his certified insurance counselor designation and expansion of McCool Risk Solutions outside the tri-state area. That's it for me. Take it away, Ed.
Thank you, Kara. All right, this is my favorite class, the most popular one that we teach, because most people are confused as to what their responsibility is inside the unit. And so I can't tell how many times I have a property manager who calls me up and says, okay, well, we told this person they're responsible for this, or they're not responsible for this, and they're generally wrong. And so this class, the actual name of this class many years back was called Are You Out of Your Friggin' Mind? Because I walked into a unit one day with a board president, and he could not understand why the washing machine hose in an owner's apartment burst and caused damage to that owner's floor, and yet the condo was responsible for the damage. And so he screamed that at me, and I had that as the name of the class for many years until someone was insulted. I ended up changing it. But the truth is, everyone is confused as to their responsibility within the unit. And the reason being is there are typically two areas in the bylaws that relate to responsibility. One is called maintenance, and the other is damage or destruction of. And so they're two different things. Maintenance, owners are typically going to be responsible for maintaining several areas within their unit, such as plumbing, fixtures, etc., because no one else has access to them. So for an example, a pipe under the kitchen or the bathroom sink is going to be the responsibility of that owner to maintain it. Now, where the confusion comes into place is these same perils may not be the responsibility of that owner if they were damaged from a covered peril. So let's say there's a fire in the unit. Well, the fire damages that same pipe. The owner is not responsible for that. The association is more than likely going to be responsible for that, depending on the bylaws. Let's take it a step further. If that pipe that the owner is responsible for maintaining bursts and causes damage to someone else's property, it's probably not going to be that owner's responsibility for the damage they caused. And so in most cases, what I tell people, 95% of the time, it's not what caused the damage, but what was damaged, okay? So in that example, the pipe that burst, that's what caused the damage. But the responsibility is going to go back to what was damaged, and that could be personal property of an owner, it could be the unit, which may be the association responsibility, and maybe improvements that are somebody else's or different owner's responsibility. But if you keep that in mind, what caused it, it's not what causes damage, but what was damaged, that will tell you who is responsible in 95% of the claims.
So question.
Yes.
So if a pipe bursts in unit 2A and causes damage to the unit below 1A, to their television and couch, who would be responsible for the damage?
Well, if we go by that, it's not what caused the damage, it's what was damaged. What was damaged here was the TV and the couch. Contents coverage is going to be the responsibility of that owner. So although the pipe in 2A burst, it's going to be the owner of the couch and the TV who's responsible for replacing and repairing their items, which we'll get into a little further, and that's the need for homeowners insurance. Now, however, let's take a step back. I said 95% of the time, it's not what caused the damage, it's what was damaged. Well, the other 5% of the time basically is negligence. So if there was negligence on the part of an owner and they caused damage to someone else, they're technically responsible for the damage they caused. And so we can give some examples of negligence. And I'll give you some examples we've actually had in our agency. We've had people left the bathtub running. It was one day a guy was watching a football game, ran the bath either for himself or his wife, completely forgot about it, and it overflowed and seeped down and caused damage to units below. That is negligence. Other ones of people falling asleep in bed with a lit cigarette. We've had people who have left the stove running, things like that. Those are kind of clear-cut cases of negligence. And the definition of negligence is what a prudent person wouldn't do, basically. Now, on the other side, what isn't negligence, and some people think it is, and a lot of times the property managers think it is, as well as that pipe bursting, causing damage, a hose attached to a washing machine or the dishwasher bursting isn't considered negligence. Some owners responsible for their own water heaters. Those bursting are not considered negligence, despite the fact that they may only have a life expectancy of 10 years and they may be 15 years old. Them bursting is not considered negligence. So it's not always easy to prove negligence. Another time where there may be an exception is the deductible resolution. So you have more and more associations who are amending, and we see this more in New Jersey than in New York. We see more and more associations who are amending their governing documents or the bylaws to indicate something different. So for example, I've seen a couple of different ones. The two that are most popular is one of them amended their bylaws to say that if a claim starts in one person's unit and simply stays and does damage to that unit, that person is responsible for the claim. So that would have been the solution for that board president who yelled at me many years back. That would have basically put the onus on the owner. The second one is we're seeing the associations are now putting the deductible really on the owners. So for an example, if a claim or if a peril does damage to one unit, well, that owner is going to be responsible for the association's deductible. If there's damage to multiple units, those units would all pitch in basically and share that association's deductible. And the only time the association would be responsible for the deductible is if it was damage to the common areas, because that is their responsibility.
Why is it a good idea for the board to amend the bylaws to include deductible resolution?
Because what it does is it takes the onus off the association. And in this day and age, most associations don't have lower deductibles. They have higher deductibles. And a lot of the times the damage may not be to common areas, that to people's apartments. And so it may make it just a little bit more feasible for the association. If they have 3 claims in 1 year and they have a $10,000 deductible, well, they got to pay $30,000 out of pocket, okay, to cover that. So if people have homeowners policies, typically their homeowners policy will pay for the deductible that an owner is responsible for. So if it is possible, and in New Jersey, it certainly is. In New York, usually it can be done with co-ops, but not condos. It's a good idea to look into. Now, the bylaws will indicate the responsibility of both the owner and the association. Most people are under the impression that the insurance policy says, okay, this is what we're covering. That actually isn't true in most instances. Most instances, the insurance policy says, okay, we're going to cover claims and we're going to adjust claims based on the way that the association's governing documents read, or the bylaws. And typically you'll see the following terminology. It may not these actual terms, bare walls, all in, and single entity may not appear in the bylaws, but the description will. And so there's really 3 ways that associations are written. Now, bare walls is one of them, and typically that is probably 5% of the times. It only applies to condominiums, does not apply to co-ops. And what bare walls says is the association is only responsible for the structure itself and the 4 walls and ceilings and original floors within the unit. And the owner is responsible for everything else, including the cabinets, partition walls, and basically it's an empty box they're given. So there's more responsibility on the owner and less on the association in this case. And again, these are only condominiums, and we don't see it too often, maybe 5% of the time. Then you have all-in coverage. All-in is kind of the opposite. The association is responsible for placing the unit, including any improvements or betterments made by the owners. So what happens is technically the owners don't need to maintain dwelling coverage or coverage on their improvements or betterments because it's covered under the association's policy, which that puts much more responsibility on the association and very little on the owner. And then we have single entity, also known as original specification or builder's spec, which basically that is That is 90% of all condominiums and 100% of all co-ops are written this way. Basically, is the association is responsible for replacing the unit back to its original condition as purchased by the original owner. So at the time of conveyance, and the owner is responsible for any improvements they or any prior owner has made. And so again, co-ops and condos are typical. Most all co-ops and most condominiums are insured this way. Typically, in a co-op, there may be some differences. They may be responsible, such as finishings, carpet, paint, things like that. But basically, this is the way most associations are written. So if you buy a unit and you buy it originally when it was built and you don't make any improvements, well, the association has really the responsibility of putting that unit back together. Once you make improvements to it, those become your responsibility. Now I sell the unit to you, Stephen, and well, now Stephen is responsible for the improvements that I made, despite the fact that he didn't make any. Okay, so that's what happens is any improvements made become the owner's responsibility.
As a unit owner, how could I know what improvements you made to the unit?
It's a good question. So if the unit owner did not make those and it was a prior unit owner, there's really a couple of different ways. One, the probably the easiest way would be to check out a unit that is comparative, so that may not have done as many improvements or may not have done improvements to those areas. Secondly, there may be some information in the governing document, so the original offering plan that lists what kind of materials they're going to use. And there could be some differences because some owners may choose at the time pre-construction basically to upgrade their unit in certain facets, and those are considered the original unit. So there may be some differences, but the easiest way, one, again, is to take a look at one of the other units. Two, check out the governing documents. And lastly, other ways that sometimes the adjusters are able to look is they sometimes can look at at certain materials or improvements made and know that's an improvement, that buildings weren't built with that material 20 years ago, 30, 40 years ago. So they know that something is an improvement.
And as a unit owner, what's the best way for me to figure out how much I should insure my unit for?
Another good question. We get that all the time. The easiest way really is to kind of get a contractor in there or someone who can really just decipher and say, okay, well, this kitchen is going to cost this much to replace, this bathroom, and those are the two most popular areas that are improved. They're naturally going to be the kitchen and the bathroom. So it would really kind of be to get an interior designer or a contractor in there who can give them an estimate of the replacement cost. Every contractor basically, for the most part, uses software like insurance companies do, and they punch in the number of square footage and the type of material, and it spits out a figure of what the replacement value is and what the work would cost. So the easiest ways to be would maybe get a contractor or a contract company in there to give them an estimate. All right, so every association should require homeowners insurance. We're going to tell you why. Confusion, confusion, confusion. As I said before, no one is really understands what the community association responsibility is and what the owner's responsibility is. They can read the governing documents, and the truth is it's very confusing. There are times where insurance companies don't really, the adjusters can't decipher it because sometimes it's ambiguous. So there's always going to be confusion. For shareholders in a co-op, the banks and the mortgage companies don't require homeowners insurance as a prerequisite for a mortgage. Okay, in a condominium, when someone's taking a mortgage, they have to show proof that they have coverage and that the association has coverage. But in a co-op, the shareholder only has to show proof of coverage that the association has coverage, not themselves. It's a true story, but my father, Stephen's grandfather, who opened up the agency in 1987, bought a co-op somewhere along the lines of the mid 90s. And it was about 60 days before he realized he didn't have insurance. Now, this is the guy who opened up the agency, was teaching these classes way back when, and he didn't have insurance for his co-op unit. So it certainly could happen to anyone, and it does happen all the time. Owners typically don't realize that within the unit, they are also responsible for improvements and betterments made by a prior owner. And the question Stephen had posed before is, well, how do I know? Well, truth is, there's probably plenty of owners who may not realize that their units are improved. They don't think about it. But in almost every instance, an owner is going to be responsible for the improvements that they made and prior owners made, because the association responsibility is to put it back really to the time it was built. And when an uninsured owner is sued for damages by another owner or their insurance company, the board and management firm will almost always be dragged into the lawsuit. It happens. And in every case, so if an owner doesn't have insurance, they either look to the board to help them pay for things. If they're being sued by another insurance company, they may turn around and sue the owner and, excuse me, the association and the property management firm. So anytime there's uninsured owners, it's going to be an onus on both the board and the management firm.
What are the consequences of an uninsured owner being sued for damages, and could it affect the value of the association overall?
It could. I mean, it could. If someone doesn't have insurance, and they are sued, well, they can't send it over to their insurance carrier for a defense. It means they have to reach into their pocket and hire an attorney. Well, suppose they don't have that money. Okay. Or suppose they don't have the money to repair their own unit if there is. So anytime that a unit isn't going to be put back to where it was pre-claim, it's going to lower the value of the unit. So there's several different instances of what can happen, and typically everybody having insurance is going to keep the peace. If I have insurance and Stephen has insurance, there may be a claim, and we may not be happy that there's a claim, but at least we have insurance to turn it around and put the claim into. If we don't have insurance, there is going to be some bad feelings, and usually that results in either him suing me suing him, us suing the board. Anytime you put a claim on record for association, it's going to be a problem. It's going to drive up insurance rates. So it behooves everyone to have insurance. What we have also found is that in cooperatives, many shareholders maintain renters insurance, which is the wrong type of insurance. They think because, well, I don't own the unit, I only own shares in the unit, that I don't need to insure the unit. And as we've said a few times before, that's incorrect. They are responsible for any improvements they make and the other prior owners that make, as well as this. Even if nothing's been improved, a lot of times they're responsible for the paint on the walls and finishings and things like that. So this will mean they don't have the proper coverage for the unit, and the co-op's insurance company is going to put back the unit to its original condition. That may be 70 years ago. So they're going to use like kind and quality materials from 70 years ago, which is going to lower the value of the unit, which is in turn is going to lower the value of the entire association. In a condominium, if the unit owner does not maintain insurance on their improvements and they are damaged, it is conceivable, and I've seen this before, depending on the way the governing documents read, that the unit will be repaired minus the improvements, such as cabinets. I've seen unfinished floors. So if a condominium unit doesn't have their own coverage, it's at best they're going to have their unit put back to the original condition at the time it was built. At worst, they may have something that has no kitchen, no flooring. And now think about that. That is tremendously going to lower the value of the unit and the association as a whole. In homeowners associations, we've seen this. Many owners carry an HO6, which is called the unit owner's policy. That's the type of policy every condominium unit owner and every co-op shareholder should have. In HOAs, sometimes their owners carry this in by mistake. So instead of carrying what's called an HO3, an HO3 insures the structure itself. The HO6 only provides for what they're responsible for in the unit, which is typically not going to be the exterior. And so we've seen that before in associations. And what happens is boards are constantly confronted with charity decisions when there is inadequate coverage. What I tell every association is, listen, you can't make these charity decisions, because if you do it for John Smith and then you don't do it for Jane Smith at a later date, there could be discrimination. They can sue. And so it's really important to make sure everybody has homeowners insurance. Okay, how do you monitor coverage? If it is required as part of the governing documents or in the bylaws, I won't say it's relatively easy, but it can be done. If it is not required inside the bylaws or the governing documents, then what should be done is the association should attempt to institute it, including minimum limits of coverage should be established to ensure adequacy of coverage. Now, you can't say, well, every unit has to have this much because that's how much they're responsible for, but you could put a minimum in there. So something like improvements or betterments, maybe say 25,000. Now, that may not be enough to rebuild what owners are responsible for in the unit, but that gives them at least a base that everyone has to have at least a certain amount, and then it's up to them to discuss with their insurance brokers. There should be some form of penalty for owners who don't comply. If it's required, but there's no penalty or no bite, I call it, when I don't comply, what are you going to do? There's nothing in the governing documents that says you have any recourse. So if it's in the governing documents, it should be, and there is no penalty, it should be amended. If you're amending your bylaws or governing documents, in addition to the limits of coverage that we discussed, there should be some kind of penalty in there for people, for owners who don't comply. Each current owner should provide proof of coverage upon inception of the requirement, showing that they not only have an insurance policy, but meet any possible required limits, because again, there may be different requirements in terms of liability insurance or improvements of betterment or their contents coverage. If possible, the association be listed as an additional interest on the policy so they can get notice of cancellation. Most people think that they should be additional insured. So property managers and boards will list and say, well, we want to be an additional insured on the homeowners policies. Most homeowners carriers will not list the association as additional insured. They won't do it. It just provides too broad of coverage. So what you want to do is at least you want to be additional interest, because you want to be getting notices that the insurance policy is canceling. Additional insured means you are an insured on that policy and could conceivably seek coverage in the event of damage. And that's why the insurance companies don't want to list associations as additional insured. So if that is one of your requirements, you probably need to change it, because it's very difficult to comply with. And since everyone will have different expiration dates, proof that coverage has been renewed should be supplied shortly before or at the renewal of the homeowners policies. And so what that means is basically, and we have a department that really kind of monitors insurance. What we do is we require it on a certain date, whatever date the board picks. Let's say it's July 1st. Well, on July 1st, everyone supplies proof of coverage. And then let's say my insurance expires August 1st. Well, if I only do it once a year on that effective date, I don't know that somebody's policy hasn't lapsed in between. So I might have supplied proof of coverage on July 1st, but come August 1st, my policy lapsed, and then the association is not going to know until 11 more months until the next July. So owners should really be providing proof, not only initially the first time, but every year before the policy renews. And any new owners would need to supply proof of coverage prior to closing. And that way you make sure that everyone has, and coverage is always maintained. All renters or sublet should be required to provide proof of a renter's policy prior to occupying the unit. That benefits both the owner and the association. Like we said, and I just said, in order to guarantee success, this needs to be an ongoing process through the year. Boards are not equipped to handle this. They've tried before, and it's a very tedious process. What happens is they end up dumping it on the property manager. And first off, it's very time consuming. The property manager doesn't want to do it. This is not what they feel they're being paid for. But it's also, most of the time, they're not going to do it well, because again, they're going to pick that one date and say everybody's got to supply proof of coverage August 1st or July 1st, and then they'll do it again next year. And think about it. If you have 100 different owners, they have 100 different expiration dates, or that's an average of 8 per month. So you need to make sure that everybody renews their insurance every month. And that's the way we've described would be the way to do it. There are other entities, excuse me, our agency has a monitoring program for a number of our clients. There are other entities who do it as well. So my suggestion is to anybody looking to do it, look for a company that's going to do it rather than trying to do this yourself. All right, let's go into a typical homeowners policy and the coverages that every owner should have, and the benefit to, it not only benefits themselves, but it benefits the board, and it benefits every other owner as well as the property manager. So the policy is typically known as an HO6 unit owners policy, but again, it covers the condominium unit owners and it covers co-op shareholders. It's going to provide coverage for what the responsibility is within the unit, which we talked about before, is in the governing documents. In some cases, actually most cases, the XO6 will cover losses under the master policy deductibles for damages resulting within the unit. So again, if the owner is responsible for the association's deductible, it can be paid for under the homeowner's policy. There's always 5 coverages that we tell everyone they should have. And this is actually what we tell all the boards that they should maintain or put into the governing documents. They should list what coverages that they want the owners to have, and at least list some minimum suggested limits. The first one is dwelling. It's also known as improvements, abetments, or additions and alterations. And it simply provides coverage for what the owner is responsible for within the unit as per the bylaws. So if an owner is responsible for improvements, well, this is where it's going to be covered. If they're responsible for the entire unit, like bare walls, this is where it's going to be covered. And it's probably going to be different for all owners. I may have done more improvements than you have, Stephen. Somebody may not have done anything. And by building, one condo next to another, well, one condo may have different requirements inside the governing documents. Also provides, we want to have contents coverage. Contents is the insured's personal property, furniture, clothes, electronics, things like that. What I say is the association really is never going to be responsible for contents of an owner. Okay. So it doesn't make a difference if the pipe inside the wall bursts, and that's the association's responsibility. The owner is responsible for their own contents, whether they've damaged it, whether another owner has damaged it, whether something in the association is responsible for damage it. It's the owner's responsibility to make sure they have coverage for their contents. Same with additional living expenses. This is one that jumps up all the time. Additional living expenses covers areas that if an owner can't live in their unit because it is uninhabitable due to a covered cause of loss, the insurance policy will pay for what they are accruing in expenses. And the two most popular ones are hotel rooms or dinners. Well, think about it. If you can't live in your apartment and you got to live in a hotel for 3 months, 4 months, at a couple $100s a night, it's going to be costly. And rather than that coming out of your pocket, because that's where it's going to come out of if you don't have homeowner insurance, this is what it'll pay for. It'll also pay for dinners. You don't have access to your kitchen anymore. So if you eat out every night, well, that's what they're going to pay for. If it's going to be a long-term thing and you have to go get a temporary apartment, they'll pay your rent until your unit is habitable again. So this is an area where I also, along with the contents, always say, it's not the association's responsibility to pay for the additional living expenses if someone can't live in their unit. That's their responsibility, and that's where they can seek coverage under a homeowner's policy. Then you have personal liability, and that's the one coverage that most associations that do have insurance requirements have in their governing documents. What that does is it provides coverage for what the owner, when they're negligent. Okay, so we talked about that 5% of the situation before, Stephen. Well, that's the negligence right there is going to be covered under the personal liability. Talked about toilet overflows and falling asleep in bed, a lit cigarette. That's where it's going to fall. But liability is actually very broad. So it's also going to cover if someone slips and falls in somebody's unit or their home. This is where it's going to fall under. And liability is worldwide. It's not just limited to the unit. So we've seen instances where a child unintentionally injures someone by swinging a baseball bat in the park, or a dog biting someone. Well, that's where the insurance, that's where their coverage would be covered under, would be personal liability. And the last, and the one that's getting talked about most these days, is called loss assessment. Loss assessment covers the owner in the event that the association does not have adequate insurance coverage, and they assess the owners. As long as the covered peril is a peril under the homeowner's policy. So the loss assessment covers for the owner for that assessment. For example, let's say a 50-unit co-op maintains $250,000 of water backup, but they have a backup that causes $300,000 worth of damage. Well, the association's insurance coverage is going to pay that $250,000 limit, but there's still $50,000 shortage. And so what would happen if there was 50 units there? The association could assess all the owners $1,000 each, and they could submit that to their insurance company, and they would be paid under the homeowner's policy as long as they had loss assessment. And so this coverage is coming into play more and more often. It was very big during Sandy, when there were a lot of associations didn't have proper coverage for wind and things like that. We're seeing it more and more now because of the way the insurance market is. More and more associations are taking higher deductibles. So they may take a $25,000 deductible, and then they'll turn around and let's say there's a fire, and they'll assess the owners for that $25,000 deductible, and the owners can put this into their insurance company, and typically the insurance company will pay up to whatever the loss assessment limit is, or sometimes in some cases $1,000, which in a lot of instances is plenty. So those are the 5 coverage we recommend every owner has. And again, it benefits the association when it has it, because 1, it keeps the peace, and 2, it avoids claims, and 3, it gives the board members and the board the ability to assess the owners, and it's not coming out of the owner's pocket. Excuse me. Waiver of subrogation. This comes up all the time. Most bylaws contain waiver of subrogation, and what that means is, well, first off, it can either be in one party's favor or mutual, and usually in community association is going to be a mutual waiver of subrogation. What it does, it restricts the party or parties from subrogating for damage caused by the other in the event the damaged party's insurance provides coverage. So, for example, if there's a leak in your apartment, Stephen, and Stephen's leak causes damage to my personal property or my unit, my insurance company basically pays it. They can't subrogate against the association. So what it basically does is it says, kind of keeps the peace. So the association can't subrogate out against the owner and their insurance company, and the owner can't subrogate against the association, their insurance company. Owners can subrogate against each other though. So as two owners, if there wasn't damage and you were responsible for something, I certainly could, my insurance company could subrogate against you because the waiver of subrogation covers the association and the owners. Occasionally you'll see, we've got a claim that's going on right now, you'll see a homeowner's carrier who makes the repairs and damages that are not their responsibility within the unit. So maybe the owner submits a claim and their insurance company pays for everything. Well, then they take a look at the bylaws and say, okay, well, we weren't responsible for that floor and that wall. Then they'll go back and they'll seek reimbursement from the association and their insurance company because it was damage to something that was not their responsibility. But again, waiver of subrogation basically restricts both parties from subrogating against each other if there's insurance coverage in place covering the damage. And lastly, wear and tear. Wear and tear is a typical exclusion in all insurance policies. If a pipe were to burst because it's old and worn, the cost to repair the pipe would not be covered by insurance. As we talked about it before, even if it's the association responsibility, the association is responsible for maintaining the pipe. And if it was the owner's responsibility to maintain that pipe, well, they'd be responsible for maintaining the pipe. However, if the pipe would have caused damage, then the damage would be covered. So yes, wear and tear is a typical exclusion, but I've seen instances where boards or management firms are under the impression, okay, well, a pipe was burst because it was old and it was worn, and that the damage wasn't covered, and that is not true. So in almost every insurance policy, a burst pipe is going to be covered peril, and so despite whether it burst because it was cold out or because it was just old and deteriorated, the resulting damage would be covered under as a cause of loss. All right, we have a bunch of questions here, so we're going to go through them. In your experience, what are some of the most common misconceptions property owners have about their insurance responsibilities in community association? How can these misconceptions be addressed proactively? Well, let's answer the second question first. I'd have the insurance broker really kind of provide a guideline of what the responsibility is within units. Again, all they got to do is take a look at the governing documents, and they can tell you what's responsibility. Most common misconception is that it's my responsibility to maintain that pipe or that washing machine hose and it burst and cause damage to someone else, and that I'm responsible for the damage that caused. And again, most of the time it is, and it goes back to that 95% of the time. It's not what caused the damage, it's what was damaged. How should a community association determine the appropriate level of coverage needed for their property and liability insurance? I don't know if this question is asking about owners or the association itself. I'm going to assume it's the association itself. As far as property coverage, insurance companies and insurance brokers typically have software. They punch in a number of factors, and it gives an idea of the estimated replacement cost of the building. The only really true way is to hire an appraisal company to go out and basically an inspection and an appraisal. They'll submit an appraisal report, and it's going to detail from top to bottom the actual replacement cost of the building. There is a fee to do so. So a lot of associations typically aren't going to do it, but for the most part, an insurance company runs software called Marshall & Swift Bex. It puts in a number of different factors, and the thought process is that it's going to be within 15% higher or low of the actual replacement cost, and that's probably the best way to do it. As far as the liability insurance, 5 years ago, my answer would have been different. These days, the It's very difficult to get umbrellas, and umbrellas are extra liability insurance. So most associations don't have just the base limit of $1 million that's provided by the package in the D&O policy. You usually have umbrellas, but it's very difficult to get these high limit umbrellas these days. So realistically, it boils down to what is affordable, or in some instances, you may have a mortgage company who is dictating how much insurance you need to have. And so, that's typically the way these days, how you determine it. In what scenarios might an owner's personal insurance policy need to complement the association's coverage? Well, it could be damage inside the unit. The walls and the floors and the ceiling may be the association's responsibility, but like we said before, the improvements are the owner's responsibility. And since insurance policies typically don't overlap. They fit together kind of like a glove or a puzzle. And in which case, there may be multiple responsibility inside the unit, maybe some association responsibility, maybe the owners, and that's where they complement each other. And so if there's a claim in there, the insurance companies work together because the owner's insurance company isn't paying for what they're not responsible for, and neither is the associations. How best to deal with adjusters that don't know the repair cost in New York City? Two ways. You could either hire a public adjuster, which insurance companies are not big fans of because they can be a nightmare sometimes. And listen, they're paid to make sure you get the most of the money, and they take a percentage of it. And so that is one way. Another way would be simply get an estimate. You have to understand that the insurance company doesn't do the work. So if they come in and say it's $50,000, they're not doing the work. You need to have someone come in and provide an estimate anyway. And so my suggestion, I always tell associations and boards, is when there's a claim, I wouldn't wait. I'd go out and get an estimate on the repair of the damage, and so and get two if you need be. And that way, at least you have some firepower. So if the adjuster comes back and says it's $50,000 claim, but you have two estimates that say $100,000, well, generally the adjuster will take a look at that and to negotiate that up basically because they can see it's not being done for that. So those are the two typical ways. I would get an estimate as quick as possible. You don't want to wait for the adjuster to submit his figures and then go get an estimate because it's just backing up the claim. Do condominium or homeowners policies include any coverage for offsite accommodations while repairs are being made to the unit? Is this required? Well, yes, that's what we had indicated before, that they have what's called additional living expenses inside the homeowners policy. That typically, in order for that to kick in, it's got to be due to a covered cause of loss. So, and basically fire, hurricane, burst pipe, things like that. What isn't covered is there's some situations where associations need to move the owners out because, let's say, they may have to repair an entire gas line and whatever line in the building. And so that's not a covered cause of loss. So that would not be covered under the homeowners policy. But if the unit is uninhabitable because of a covered claim, covered cause of loss, that's the additional living expenses. And is this required? If it is not in the governing documents, it is not required. If you do purchase a homeowners policy, it's always going to be in there because it is a percentage of the coverage that you have. Okay, but it is not required unless it's in the governing documents. How does the insurance needs of a large community association differ from a small one, and what considerations should each size group prioritize? They're always going to be different. Larger associations are probably going to have more exposures. I mean, if you think about it, pools, golf courses, many more amenities. And so smaller ones have less exposure for the most part. And so when you say what considerations, the amenities are going to be considerations. There are associations who have these buses who take people around. And so what you need to prioritize is the more exposure you have, the more liability insurance you want to have. And so maybe a smaller association may only need a $10 million umbrella, but a larger association that has multiple swimming pools and a bunch of exposures may need 25, 50, or even higher. Don't banks require insurance once the mortgage is approved? Please advise. Banks require insurance for a condominium unit owner. Banks require insurance coverage for a co-op if they're taking out a loan. Banks do not require co-op shareholders to have insurance as part of their mortgage. And that's where some of the confusion comes into place again. So it's condominium unit owners who are taking a mortgage, co-op buildings who are taking an underlying mortgage, but not co-op shareholders who are taking a mortgage. Can you elaborate on some real life scenarios where having the right insurance coverage made a significant difference for a community association or its members? Oh, absolutely. I mean, I've seen instances in where owners did not have insurance coverage and could not rebuild their unit back to the way it was. And so in one of the condominiums, the way the governing documents read is that the association did not have to put it back to its original condition at conveyance. It was basically the owner's responsibility and they had no responsibility. So I've seen units that were not put back together. I have seen times where people have didn't have insurance and had damage. So let's say I was damaged by Steven. I don't have insurance coverage. What's my recourse at that point? It's to sue the association. And I've seen associations where owners didn't have insurance who are being sued for property damage because the owners didn't have insurance. It reflects on their loss history. And anytime a claim is submitted to an insurance company, they document it. And when we have to remarket the insurance to various carriers, we have to show claims history. It's called loss history. And so there's been plenty of instances where there's been these small, I'll call them annoying claims on that because owners kept suing the association for their damage and the insurance premium skyrocketed. And so that is probably the most blatant example there. I've seen scenarios where people have actually gotten into fist fights because someone took damage from someone else, and without insurance, they weren't very happy. So there's plenty of scenarios. In what ways can community associations mitigate the financial risk associated with inadequate or lapsed insurance coverage? Listen, the best way to do it is to monitor it, and that's the reason we talked about that before. If someone doesn't have insurance or they have inadequate insurance, there's really not much you can do about it at that point. And so the best way to mitigate that is to incorporate it into the bylaws that insurance coverage needs to be maintained by the owners, what types of coverages they should have. If you just say they have to have insurance, you may have an owner who only gets liability insurance and they don't cover what they're responsible for in a unit. Well, that's not really helping that much. So we want them, the best way to do is put it in the governing documents, get it in there, what coverages they should have, and even some suggested minimum limits. And then you need some place to monitor it. And like I said, we do that, as does, I'm sure there's another one or two entities out there, and more will probably come because more and more associations are putting this there into their bylaws. What is the standard process for resolving disputes between the association's master policy and an individual unit owner's policy when it comes to coverage responsibility? Well, realistically, the responsibility is laid out in the bylaws. And so what happens is in the event of a claim, both adjusters, the adjuster for the homeowner and the adjuster for the association, are going to require a copy of the bylaws and want to see, and if there's been any resolutions, they want to see that because they want to dictate who is responsible for what. And in most instances, it should be relatively clear. Okay, well, I mean, if I've done improvements and the governing documents say that the association is not responsible for the improvements, well, typically adjusters work together to an extent, and the insurance policy for the association says, okay, here's what we're responsible for, here's this. And then the homeowners will say, okay, well, we're responsible for the improvements, and they'll incorporate that in as well. So the disputes, hopefully there aren't too many disputes. And again, the easiest way is to show the responsibility within the unit, connect the adjusters to work together. And most of the time that should suffice. How should the responsibilities for insurance coverage within individual units be clearly delineated and communicated to owners? Well, once it's in the governing documents, a kind of memo should be distributed to each of the owners so that they understand that they have responsibility, what they're responsible for maintaining, any certain coverage limits. You can certainly have the insurance broker for the association speak with them. In this day and age, it's much easier than it was pre-COVID. Pre-COVID, you had to go stand in a lobby or something along those lines and hope owners showed up. This day and age with Zoom, these can be done on a regular basis. And so education is basically the easiest way. So a clear-cut memo distributed by the board. I would also make sure that the insurance broker has a meeting and holds really just the ability to show, okay, what you need to have, why you need to have, and what it covers. Because most people who don't have insurance think it's very expensive or not sure what they're responsible. So just clearing that up is the easiest way. In condos with garden level units below grade in a flood zone, is an HO6 going to provide coverage in a flood? Flood insurance does not cover improvements. Association flood policy will cover a basement and not cover improvements. Many of these condos are older pre-firm condos, so entire units normally have been improved over years, so condo association is not liable. Condo flood policies differ than the package policy in, it's called an RC BAP for a condo, okay? The condo policy that the flood policy that the condo takes out actually does provide coverage for improvements to the owners. Okay, the HO6 policy is not going to provide coverage for flood. It's an excluded peril, and what would happen is you would have to, an owner would have to go out and purchase their own flood policy for things like contents and things like that. But remember this, the package policy may not cover the improvements of an owner, but the flood policy for a condo that's taken out through national flood includes improvements made by an owner. In scenarios where a unit owner's negligence leads to damage to common areas or other units, how does the association's insurance coverage typically handle liability claims, and what steps should the owner take to mitigate potential financial impact? If an owner's negligence is causing damage to the unit, they are responsible for that. It should be submitted to their insurance company rather than the associations. If you submit a claim to the association's insurance company and their insurance company adjusts it, they're going to pay it if it's a covered claim. And what's going to happen is if there's waiver subrogation in the bylaws, they're not going to be able to subrogate against the owner or their insurance company. So it should be put into the owner's insurance and dictating negligence, and that way hopefully it is paid under the homeowner's insurance policy. It does not go against as a claim against the associations. As far as what should the owner take to mitigate potential financial impact, the easiest way to mitigate is to have insurance. Okay. Again, negligence is covered as personal liability. Typical policies have 100,000 in them. It's $4 or so to go to 300,000, and maybe $24 to go to 500,000. So you want to mitigate the financial impact, have proper insurance and proper coverage. Given the dynamic nature of community association needs, how often should insurance policies be reviewed and adjusted to reflect changes in property values, community demographics, and other relevant factors? I'm going to assume this is the community association's policy, not the homeowners. It should really be done on an annual basis. And the thing is, more and more insurance companies are starting to do it every year. And so over the last couple of years, you may have seen that your building limit has gone up each year. And some of that is just a natural inflation guard that they do to offset the inflation. But it's relatively easy to run these Marshall and Swift reports. And that's why the insurance companies are doing it. Once they put in this information, all they got to do is update it, because it automatically updates based on the cost of material and labor. So I would say every year it should be done. And most insurance companies are doing that. So it's probably not going to be something real difficult or hard work on the association of property managers. Either the insurance broker or your insurance company will be doing it. What do we ask our insurance carrier regarding living expenses and food if our apartments are not habitable? Well, what happens is you may be living out of the home for 5 or 6 months. What you're going to have to do is you're going to have to save receipts. You're going to have to show, okay, we ate out here, we lived here, and you're going to have to show proof. And usually the claim isn't paid up in front because they don't know. They may pay it. If you're out for 3 months, they may give you a little bit of a payment after 1 month and 2 months, but a majority of the claim is going to be paid when you're able to move back into your apartment or your apartment's habitable. And at that point, they usually pay the balance. So you want to save your receipts for eating and living expenses. In the event of a significant disaster affecting multiple units, how does the claims process typically work, and what are the best practices for unit owners to ensure their claims are prioritized and handled efficiently? It's tough for me to say how owners are going to make sure their claims are prioritized. What happens is if there is a claim, again, the owner should submit it to their insurance companies. The association should submit it to their insurance company. And then if multiple units are going to be, the more units that are going to be involved, the longer the claim is probably going to take. But in theory, the way the adjusting works is an adjuster is assigned usually within 48 hours to the claim. The quicker they are able to get to the building, the better. So they're going to reach out to the contact, property manager or board member, and they're going to look to set up an appointment to come adjust it. At that point, they're coming out to adjust all the damage. So the best way to make sure it goes efficiently is to make sure that everyone who has been damaged, again, not only is submitted to their own insurance, but indicates to the association, okay, we have damage. That way the adjuster can take a look at all the damaged areas. There's plenty of instances where people don't really speak up at first, and then the adjuster has to come back at a later date, and it just prolongs the claim. So typically they'll go out, once they adjust it, they will go back to their office, they type up a report. And most of it, sometimes it's going to be an outside adjuster work from an insurance company. So they type up the report, they send it to the insurance company, and the insurance company has to approve it. And so in this time period, the association probably should also have gotten at least 1 or 2 quotes for or estimates on the repair work, because again, doesn't mean the insurance company is right when they give you an idea of how much they're paying. They may say 50,000, but you have 2 contractors are saying we can't get this done for less than 100,000. So if you want to speed up the claim and have it handled efficiently, get your estimates in order, submit those to the insurance company, and that way the adjuster has that to work on. And then once the adjuster, once the insurance company approves it, they send out basically an estimate for everyone to look at. The quicker you get that back and sign off, the quicker they're going to send a check at that point. You also can request that they send you like kind of a down payment at that point or a deposit to really kind of begin the work, because many associations may not have the money to put to work. But if it's a significant claim and it's something where they know it's a covered cause of loss, you can certainly have them provide down payment at that point. Can you explain the impact of a large-scale claims on a community association's insurance premiums and coverage options in subsequent years? How can associations mitigate these impacts? Claims are the single biggest reason why insurance premiums go up. Okay, so insurance companies are in business to make money. Simple as that. What they do is they normally look at what they take in, as they call it, a loss ratio. So they're going to say for every dollar that you've paid in insurance premiums, they don't want to pay any more than, let's say, 35 cents on a claim. Okay, they want to make that 65% profit. Not that that's profit, but they also have to pay out expenses. So realistically, an insurance company needs to make sure for every dollar taken in that they can pay out for claims and they can cover the expenses. And if they're not able to, they're either going to do 2 things. 1, they're going to raise a premium to make sure that they do recoup this money, or 2, they're going to cancel you. And that's the worst of the 2 options, because once they cancel you for poor loss history, when the insurance broker goes out to market, the insurance company is going to see, okay, they were not renewed by another carrier. Again, as I said before, we have to supply proof of your loss history. They're going to see these claims on record. And so now what's the impact? The impact could be small, or it could be, I've seen associations that have increased by 800%. I've seen associations that have gone from 100,000 to 800,000 in 1 year. I've seen associations that have gone up 250,000, and that's lasted for 5 years. So it's been over $1 million in insurance premiums because of claims. What I always say is one large insurance claim is probably not going to be nearly as bad as many smaller ones. And so how do we mitigate these impacts? Well, one, you want to raise your deductible, because you want to take out the smaller claims. So if an insurance company sees that we have pipe bursts every year and they're not paying out a lot of money, maybe they're paying out $1,000 here and there, but they see 6 or 7 every year, or 3 or 4 every year, or 15 in the last 5 years, you can be sure they're going to say, well, maybe paying small claims at this point, but eventually it's going to be a large one. And they feel there's issues with the pipes or the plumbing. Likewise, if they see a lot of slip and falls, they may say, well, what's the issue there? Are we not salting the sidewalks after a storm, or is the sidewalk in poor condition? So it's usually not that one large claim that gets you in trouble, it's the smaller one. So you want to increase your deductible. Okay, that's number one. Again, let's go back to requiring everybody to have homeowners insurance. It benefits the association at that point, because they can either assess the owners at that point to make up for that deductible, and which is going to be kind of a win-win in most situations. So anytime you can keep claims off record, you want to. And another way to mitigate it is if you have, let's say, a $10,000 deductible and there's a $12,000 claim, I don't think I would submit that claim for reimbursement for $2,000. That $2,000 is probably going to cost you more in the long run. How do you balance the cost of comprehensive insurance coverage to the need to keep association fees affordable for all unit owners? That one I don't have the answer for. The easiest way to keep insurance premiums down is to not have claims. And sometimes you can control that, and sometimes you simply cannot. So sometimes it's the luck of the draw. I know some beautiful buildings who have had bad luck with claims, and I know buildings that are probably not in the best condition who don't have claims. So how to balance it? Raise the deductible. There's going to be situations where you're going to have to either assess or raise maintenance. I mean, that's really the only two ways associations can bring in money. I have a condo in Florida. I understand I've been assessed 3 times in 3 years. I've had 3 maintenance increases. So it really is difficult because some things are out of our control. We're in a hard market right now, and a hard market is basically where insurance is cyclical. It goes from hard markets to soft markets. And prior to 4 years ago, it was kind of a soft market where insurance premiums were level. But insurance companies are cut between the number of natural disasters, and there was something like 25 of them last year that exceeded $1 billion. You take that, you take the fact that more liability claims are exceeding 7 figures these days. What happens is it flows down to all the insurance companies, and that flows down to all the associations, whether there's positive or negative loss history. So it's a very difficult to answer that question. The best thing you can do is, again, is try not to submit claims and keep and have reserves, so that way in the event that premiums do increase, it's coming out of the reserve and you don't have to raise maintenance or assess. In cases where a unit owner's negligence leads to damage affecting multiple units, how is responsibility allocated and what is the legal ramifications for the responsible party? Well, if they're damaging, if there's negligence on that owner's part, they're really responsible for the negligence they cause, whether it's to other unit owners or whether it's to the common areas of the associations, their responsibility. In terms of how is the responsibility allocated, well, it typically is 100% their responsibility. If they're negligent and it's proven to be negligence, it's their responsibility. What's the legal ramifications for the party? Well, if they don't have insurance coverage, let's say, they are typically still responsible for the negligence. They can be sued by the other owners who were damaged and the association who was damaged. Now, instead of having your insurance policy pay for either the damages or the liability that you're being sued for, now you're reaching into pocket. And so the legal ramifications is having the money to hire an attorney out of pocket. What's the percentage charge for the insurance program? I'm going to assume that is the homeowners monitoring that we do. It isn't a percentage charge. It's usually a per unit charge. It ranges anywhere from, depending on how many requirements there are, but let's say I'll shoot out a number of $10 per unit with a minimum premium, if I remember correctly, of $700. So again, the more requirements there are, it could be a little bit more. And if there's only one requirement, such as liability, it may be a little bit less. But if you go with the $10 per unit with a minimum of $700, that should put you in the area. With the evolving nature of property values and market conditions, what strategies do the association recommend for owners to regularly reassess and update their insurance coverage to avoid underinsurance? They should have dialogue with their insurance broker each year. Okay. And the thing is once they're able to determine what their responsibility is in the unit, it's usually relatively easy to determine, as Stephen had mentioned before, how do they know what they're responsible for? Well, if they get an estimate, that estimate can usually be upgraded. And if they go and do more work in the unit, well, then they need to factor that in. Okay. But they probably should assess it once a year as their coverage is renewing. In your opinion, what specific factors have contributed and will contribute to the higher premiums costs moving forward? If I could tell you the three, one, natural disasters have increased dramatically. There's more of them last year and the year before than ever before. Secondly, on the liability side, one of them is specific to New York and the other is specific countrywide. In New York, the labor laws are completely against the property owner. So if a contractor is injured while working, the property owner is typically 100% responsible in most cases. And so you have these contractors who are getting injured or their employees are getting injured, and workers' compensation basically says you can't sue your employer. So if I'm a contractor and my employee gets injured, he can't sue me for the most part, but he can sue the association. And that's what they're doing. And there's been more of these suits in the last 10 years than there were ever before. And these suits have gotten higher and higher. So that's specific to New York. Countrywide, it's called social inflation. And that is basically defined as, suits have increased. And so the juries have gotten a little bit more willing to pay damages, or basically whether it's a distrust of insurance companies or deep pockets, or it's just a generational thing where you have a different generation who is thinking, okay, well, they're awarding more money than ever before, and that's the reason we have seen these insurance premiums continue to go higher. And as far as insurance premiums, at some point, and it should level off, because again, the markets are cyclical. There's hard markets and soft markets, and in hard markets, the insurance companies are raising their premiums, so eventually they start making money. And then when they're making money, they take that money, they invest it. And so now they want more investment income. What they do is they start lowering their premiums because they want to get more insurance premiums in to invest it. So don't hold me to this, but what I'm hearing is, at least in New York, maybe towards the end of this year into early next year. New Jersey is usually about a year behind. But we should see some lightening of basically of the insurance premium increases that we've seen. Now, that won't be forever. As I said, hard markets follow soft markets and soft markets follow hard markets. So there may be a period of time we're in a soft market before the hard market begins. What can you do about owners with no mortgage saying they do not have to have coverage? By the way, there is a stalled legislation in New Jersey to prevent condos from passing the deductible to owners. What can you do about owners who no mortgage saying they don't have coverage? Nothing, unless there's something in the governing documents. Okay, so if there's nothing in the governing documents saying they have to have insurance, they don't have to have insurance, and that's the reason why we say change the bylaws of the governing documents. As far as the stalled legislation in New Jersey, the Condominium Act basically allows the association to pass down that deductible to the owners, to the affected owners. And so I don't know what that legislation is at this point, but I guess they're trying to prevent it. And if that happens, well, then it's really going to have to, there's going to be some different changes, but we'll see where that goes. And lastly, how does the bank handle situations where insurance coverage limits are insufficient to cover losses resulting from large-scale financial crimes or catastrophic events? And what contingency plans are in place to manage such scenarios? Well, usually the bank is covering their interest. So I don't think the bank is the issue here. If the bank is making a $100,000 loan, they usually are going to make sure you have at least that. And so the catastrophic events typically aren't the problem in terms of property, and the large scale financial claims. What we're seeing is more and more of a cyber claims. And so those are really the issues where you may have associations who are not covering their exposure in there. So again, the bank really, if we're talking about an owner, well, they may have certain requirements. If we're talking about a co-op, typically the mortgage company is going to require a certain amount of coverage, but in a lot of instances, especially on the property side, it's going to be to cover what their loan is. So more than the bank, you really should be discussing coverage limits with your broker on a regular basis. And so there's plenty of insurance brokers who specialize in co-ops and condos, and they can really tell you what you need. And that's one of the classes I teach. One of the main points in it is you want to deal with knowledgeable insurance brokers. The example I give is you wouldn't go to a podiatrist if you need a brain surgery. So it's the same thing here. Not every insurance broker really knows what they're doing when they go to condos. So if you're dealing with an insurance broker who specializes in co-ops and condos, they're probably going to make sure you have the adequate coverages that you need. And it really just boils down to how much coverage. And again, in this day and age, some of it is affordability based on maybe the umbrella, and some of it is something like the property insurance, where the insurance companies are running their software to determine a replacement cost. All right, I hope that answers everybody's questions. If not, contact info is right here. You can either myself or Stephen, and we will certainly get back to. I'd like to thank everybody for joining us.